back. We continue our special coverage of the Reserve Bank of India's monetary policy, and we're joined by special guests, to further deliberate on, what today's policy would mean for the markets and the economy in general. Neeraj, Gambhir, Group Executive and Head of Treasury and Markets and Wholesale Banking Products at Axis Bank is with us. So is Anubhuti, Sahay, the Head of South Asia Economic Research, India at Standard Chartered Bank, Ashish Parthasarthy, Treasurer at HDFC Bank, and Soumya Ghosh, the Group Chief Economic Advisor at SBI, is also with us. Gentlemen and lady, thank you very much for your time here. Mr. Soumya Ghosh, first, to you, any additional takeaways from the press conference? If you were to read, in between the lines, what would you gauge about the future trajectory of rate hikes from RBI?
See, I think, Ritu, before I answer that question, couple of small things I will say. I think from the press conference and also from the RBI monetary policy report, I think you will find that the RBI baseline assumption of exchange rate in first quarter was 76. It has now moved to 80. And also the fact that RBI has clearly mentioned that a 5% depreciation from the baseline rate could push up inflation by 20 basis points, but could also push up growth by 15 basis points. So now we need to decipher from here whether 80 is the new normal in terms of the exchange rate. Second thing is that I think given the tone of the policy and given the fact that Fed will also be hiking, I think there could be some more rate hikes. But the important point again over here is that if you look into the RBI fan chart for quarter 4, it gives an inflation number of 5%. And if you actually go by the RBI baseline projection, the number is 5.2%. So at 5.9%, and given the fact that RBI had recently expressed in one of the discussion papers that the neutral rate could be anything between 80 basis points and above, we are very close to the neutral rate, if not at the neutral rate. So any rate hikes beyond this point, I think, could be an insurance against the Fed policy rate hikes. So overall, I think it's a balanced policy, and the statements on the liquidity actually confirms the fact that the withdrawal of accommodation could continue because government cash balances still remains uncomfortably high at 3.7 trillion. So overall, the policy was on expected lines, and the governor has cleared many things which basically the markets wanted to know. For example, the reserve adjustment in terms of the revaluation.
Okay, thank you very much, Soumya, Upasana, Ashish Parthasarthy and Neeraj Gambhir. This is such an as-expected policy that there is precious little that we can add. But I think the bankers will have a lot to say. Ashish, what is the sense you're getting in terms of the liquidity deficit from the press conference as well? We tried to lull the governor into answering something about provision of liquidity, assurance. But what is the overall sense you're getting on liquidity? Do you think Repo is going to be the interbank rate, not the SDF?
No, that's quite likely. You could have Repo as the interbank rate. That's, of course, the policy target, right? Weighted average call rate is supposed to be the Repo. It could be Repo, it could be slightly higher, given, the liquidity situation right now. But if the government, spending happens as expected, yes, then you possibly risk Repo, sometimes this side of Repo, sometimes higher than Repo. But that's where it is. So liquidity from a primary, surplus is one way to look at it. But the other way to look at it, and I think the governor mentioned it in his press conference also, that the liquidity surplus has fallen from 8 odd lakh crores to almost neutral, or it could be 1-2 lakh crores surplus. What that has caused, and you've seen that, is that it has resulted in lower levels of deposit growth, right? And as compared to credit picking up, and we've not even started the busy season, so that is likely to put more pressure on banks in terms of deposit rates, and we've been seeing that in the market. So liquidity, primary surplus versus what is happening in the banking system, there could be slight moves which could be slightly divergent.
Yeah. Okay, so Ashish, can we say that going forward, maybe deposit rates will have to be hiked as much as lending rates, or maybe even more than lending rates?
No, that's a difficult thing to say. Well, again, lending rates, there are two ways to look at lending, three ways to look at lending rate. One, of course, most of the lending rates, a significant proportion of banking lending rates are linked to a market benchmark, either to repo or T-bills. The other, they're linked to MCLR. MCLR is an outcome of your cost of liability. So obviously, if deposit rate goes up, MCLRs will go up. And third are fixed rates. Which are most of the EMI loans, that would primarily be driven by demand supply, right? That's while, of course, there would be upward pressure, it will also be driven by demand supply factors.
Okay. No, I mean, I still think that there is a sense of liquidity deficit and there was not much assurance from the governor. Same question to you, Neeraj. Do you think going forward deposit rates have to go up at least as much as lending rates or maybe even more?
So Lata, different parts of the deposit market are reacting slightly differently. We have seen a significant uptick in the bulk deposit rates. If you think of certificates of deposit as a kind of deposit, then there we have seen a complete reprice in line with whatever has happened in the repo rate market. Where we are seeing some kind of a slow sort of adjustment is basically in the retail deposit rates, which is less than 2 crore size. I think there also banks have come up with specific schemes. I think almost every bank today has a specific scheme for some segment of the market or some tenor where the rates have actually been higher. So in general, what I would say is the deposit rate adjustment is a continuous process. Different parts of the markets are reacting differently. And as we go forward and as the liquidity in the system sort of tightens further, from the current surplus, I think the deposit rate market will also keep on reacting. And as Ashish said, the lending market also is kind of, in some parts, because of the linkage with the EBLR, the adjustment is quite quick. In the other parts, like where the MCLR is the base, I think the adjustment is dependent upon the bank's cost of funds. So there it may be slightly delayed. So again, different parts of asset market are reacting at a different pace.
Okay, well, I'm actually coming from the angle that bank investors are now should they revert to the view that now margins can't expand? Until now, every rate hike was an expansion of margins. Will it be an expansion going forward? I'll come back to you in a minute. Just this question to Anubhuti, exactly the same that Ritu asked Soumya. What are you making of the peak rate from what the governor has said? How much more have we to go, Anubhuti?
As per our forecast, Lata, the terminal repo rate clearly looks like to be at 6.5%. I would say that risks are on the upside rather than downside. More than today's meeting, I think the minutes would be very interesting to watch out for. In today's meeting, we saw an emergence of, if not a dovish, at least a relatively less hawkish member, because Ashima Goel voted just a 35 basis points rate increase. At the same time, the governor referred to high real rates in 2019. So from the minutes, it will be very interesting to see how each member is thinking about real rate, and especially from Ashima Goel's statement, and not to miss Professor Verma's statement, because if you recall, in the August minutes, he was not in favor of a terminal repo rate at 6.5%. Has that changed? I think that will be far more interesting to watch out when it is released on October 14. And given the governor's statement that we are living in a third shock where global rates are moving higher, I think risk to our terminal repo rate forecast of 6.5% is clearly on the upside, and the governor has kept all his options open.
On the upside, okay. Ritu, go ahead, please.
Well, Mr. Neeraj Gambhir, again, this question to you, and I'm just putting it out there for your thoughts. This big third shock that RBI has been talking about, there is an upcoming federal meet in November, whereas RBI's next MPC is only going to be in December. Any chances at all of a, out-of-turn rate hike from the RBI to react to that, you think?
No, I think it's highly unlikely that we will see an out-of-turn meeting, out-of-turn rate hike in India. We are on a very calibrated rate adjustment path. I think the governor's this policy also made it amply clear that they are looking at domestic factors. Monetary policy is largely driven by domestic factors. We have our own, inflation trajectory to follow. We have our own growth trajectory to follow, and Reserve Bank is primarily looking at the two. The question was specifically asked with respect to the impact on currency. That is a factor, but I think the dominant factor seems to be where the inflation is headed and where growth is headed. So I don't anticipate a one-to-one correlation between what US Fed is going to do and what India is going to do, but I think we should be mindful of the fact that it is a season of global rate hikes. All central banks are on a pretty significant rate hiking cycle, and I think India is also part of that. The timing may be here and there, but eventually we will see a higher policy rate than where we are, and maybe about 100 basis point higher is what is possible over the next, say, about 6 odd months. So I think that's where we are currently, and I don't expect a like-to-like sort of increase in India compared to what US does.
Okay. Soumya, you gave me the impression that we're almost already at peak rate and further rate hikes may only be an insurance hike. You think the Reserve Bank can stay mute when the Fed goes on and on, policy after policy?
Yes, that's why I mentioned the term insurance rate hikes, because if the projections for RBI next quarter Q4 is 5 or 5.2% or 5.9%, you already have a positive real rate. If I assuming that is we are working on the expected inflation, so I think there could be another 35 basis point rate hike at 6.25%, because in December the RBI policy announcement is before the Fed. So the RBI will take into account that 75 basis point hike in December. After December, I think after November, and in December for the 50 basis point rate hike, the RBI could actually go for an calibrated rate hike of 35 basis points. One small thing before I end, Lata, I think you have asked this question on deposit rates. There is a very interesting graph in the RBI MPR which clearly shows that in a rate increasing cycle, the increase in deposit rates always lags the lending rate to a significant extent. I think, and that is across all banks, public, private, foreign, and all banks. So I think that the increase in the deposit rates could be more in the second half, as if the credit growth continues on its current traction.
Yeah, fair point. The governor mentioned that in the press conference as well, that, it always moves with a lag because of the liquidity. Ashish, what's your sense of credit growth? It's seeming at 16.2 for the industry and much more for a bank like yours. Does it go even higher?
So again, year-on-year numbers, will depend obviously on the base. But I think overall, if one can say the credit growth is strong and it is broad-based.
Okay, and you don't worry that with this 50 basis rate hike, at least the pace of growth of credit may come down?
So at this point in time, very difficult to say, but we are just at the beginning of the festival season, beginning of the busy season. Sitting here, I don't think this rate hike should impact credit growth in a big way. I think the credit growth, as I mentioned, is strong, and we expect it to continue to be strong.
Okay, Anubhuti, also, the MPR, which some of the participants brought up, it also indicates that CPI will average 5.2% in the next year. Just your quick thoughts on what this would mean in terms of also a change in stance, and if now a shift to neutral, will that even have much of a relevance?
Yeah, so first of all, look, MPR's projection are model-based, and when MPC finally gives that projection for FY24, which will be in April, there can be significant changes. But if we take the 5.2% inflation projection, our projections are at 5%. Then probably we will end up closer to real rates of 150 basis points, and that's the point when RBI or MPC can switch to a neutral stance. I think today's decision not to switch to neutral stance was judicious, because if you go by the previous standard definition as given by RBI, neutral was or neutral is equal to flexibility with the RBI either to cut, pause, or hike, it would have confused the markets. So I think we still have a couple of more meetings to go with before we can see a switch in stance towards neutral, unless we see significant changes in the world around us by then.
Okay. Yeah, fair point. Actually, stance has never been clear. It's just a set of words, and we don't know whether they're describing the current situation or guiding. Stance has been all over the place for most of the time, I would think. But okay, that's just a personal view. Neeraj, what are you expecting by way of peak rates as a person looking at liquidity and inflation? And what about the 10-year and the OIS rates? Do you think the 10-year has more to go now?
So I think with today's rate hike and the fact that we've stuck to the script as far as what was expected, I think the market will be very range bound as far as the bond yields are concerned. I do anticipate 10 years somewhere between 7.25 to 7.5. That's the broad range that I have in mind. Similarly, we could see some kind of a pullback in the OIS rates that we saw, particularly at the longer end of the curve. But I think going forward, a lot will depend upon how multiple things play out. Most importantly, to my mind, how crude prices play out, as well as how, let's say, the dollar strength plays out and its impact on the rupee. So markets will be quite alive to some of these, global variables going forward. But I think for the short term, I expect, very range bound 7.25 to 7.5 kind of 10-year bond yields.
Okay. Similar question to you, Ashish. Would you agree that there is perhaps just one more hike in place? Do you think, it's common for emerging market central bankers to not do anything when the central banker of the world is announcing hike after hike? Where are you seeing the peak? And again, 10-year.
So, I can't say there will be one hike or two hikes, as the governor himself said, is data dependent, right? It depends on what trajectory of inflation. The RBI governor amply clear that it is dependent on domestic factors, right? So it would be inflation, priority, and then growth. So from that perspective, I would, tend to agree with Soumya that, possibly we are nearing the, peak. There could be one or two more hikes. Quantums again could vary depending on the situation. So it's very difficult to say whether one or two more hike. The actions by other central banks and especially the Fed could possibly be a input in the thought process of the MPC members, but the action would obviously be dependent on domestic factors. So that's how I'll put it. In terms of 10-year bond yields, completely agree with Neeraj that it would be range bound, range of 7.25 to 7.5, very clear. And I think you will see stability, but markets will continue to react to developments in the global markets, especially on yields globally and also on the exchange rate. So we should continue to see some amount of volatility as long as that's what is expected from global markets, and we should continue to see some amount of volatility in domestic markets also.
All right, Mr. Soumya, Kanti, Ghosh, final thoughts. Any joker in the pack here? I mean, we understand the situation remains volatile. Inflation is expected to come within RBI's target by the fourth quarter. Growth projections for the next few quarters have actually been revised up. But what could, if at all, play spoil sport?
See, as of now, I think the global economy remains very uncertain, and that has been aptly summarized by the Reserve Bank. So basically, going forward, the expectation is that there will be more rate hikes coming, but it's difficult to gauge. But the only thing is, which I can say is that I think the rate hike cycle is likely to end this fiscal, and next year it could be actually looking at a different ball game if the things and the forecasts play out altogether. Because at 6.25% or whatever maybe, I think the cycle has to end by this year, even the other exigencies down. So that's the, bottom line of the entire policy.
So that looks like a very good guess, Soumya, because even the Fed dot plot is indicating that it should peak in March. So it would be perhaps in the fitness of things if RBI has also ended perhaps in February. But that's another year, another budget, another borrowing. We can't say perhaps right now. Just one word on the MPR, the Monetary Policy Report. Every twice a year, the RBI also publishes a Monetary Policy Report giving its forecast for the next 12 months. And they have given one new number, GDP for next year at 6.5. Should we get used to life at 6-handle GDP, Soumya?
Yes, I think that's a very interesting data which you point out, along with the extended base forecast moving from 76 to 80. So that means 80 could be the new normal or whatever case, and 6.5% could also be the new normal. So next year, I think we should pare down our expectations and hope for a growth rate in the range of 6 to 6.5%. We'll be happy if we get to in the upper end of 6 to 6.5%. But as of now, that's a fair number to go with for FY24.
Okay, Anubhuti, 6.5, very quickly.
We are at 5.5% because our US and Europe GDP growth forecast is less than 0.5. So it will be very difficult in our view to go to 6 to 6.5% when global growth is pretty downbeat.
Yeah, I guess it's a very long way, and nowadays shocks hit us much more intensely than we have ever been prepared for, but just for academic interest. Thank you very much, Soumya, Kanti, Ghosh, Ashish, Parthasarthy, Neeraj, Gambhir and Anubhuti for participating, Ritu Singh as well. From me and Ritu, thank you very much for joining this special monetary policy that's coming to you from Mid Street. Nothing much has changed and the bond markets are placid. Rupee as well has gained a bit, but stock markets are up and away with the monetary policy out of the way. So it's a good day from a Reserve Bank point of view. Thank you very much for watching this special.